What's up, military millionaires? Today I want to talk to you about the syndication process and a little bit just about some of the stuff that I get general questions about to explain a little bit more how it works, what it is, what it's not, who it's for, yada da 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 da. Smash that like button, subscribe to the channel, and intro. I don't know, I just felt like jumping right in, right? So syndication, for those of you who don't know, is just a group of investors pooling their money together to purchase an asset that's much larger than what they could afford on their own. So let's say I want to buy a Ferrari, but I only have $50,000 and I can't afford the financing, and it's 200 grand. So I find 3 other people, we all put 50,000 in. Now we own a Ferrari and we just split how we use it, right? So a syndication allows the general partners manage the deal. The limited partners are passive investors. So they provide money for part of the purchase, but they don't have to do any of the work, and they just get the return. And it's passive, and it's wonderful, and they get all the benefits without having to take all the time. So syndicators that's the general partners and limited partners, and you need to talk with an SEC attorney if you're ever going to plan to set one of these up on your own, because that's just way out of the scope. I'm going to be interviewing one here in the near future on my podcast, but SEC attorneys can really help you with setting up how to do a syndication, right? As far as finding deals, there's a lot of ways to do this. A lot of it just comes through relationships and networking. It can be mom and pop dealers where you're sending letters and stuff like that, but a lot of it comes from brokers. If you build relationships with brokers and they like you and they know you'll close, they can very easily send you leads on deals that are either coming in the pipeline, deals they know about. Broker relationships, like commercial broker relationships, are huge, and relationships in general. If you know other syndicators, if you know other people in the area, it can really lead to opportunities. And then after that, it's a lot of, like, you can do direct mail outs to target small, like, mom and pop apartment owners. You could probably even do text blasting. There's a lot of different options that you have as far as reaching out to these syndicators or apartment owners to see if they want to sell. And then you can always use the MLS like LoopNet or Crexi or some of these other online platforms where you can search through. Now, granted, there's other people looking at those, so it's probably not always going to be the best deal. But in a big apartment syndication, people know what they have. So it's very rare that you're not going to find like a 300-unit apartment that the owner isn't sophisticated enough to understand what they have. You're going to probably end up paying market value or close to, or, it's not like you're ever going to find a property for 50% of the value that is 300 units. It's just, let's be real. As far as finding investors, networking and content marketing, I talk about this all the time, but all the investors that I have found me through content I've put out or through me networking, and that's great. Like, you should get yourself out there, put yourself out there, talk about what you're doing. For example, I have the page on my blog at FromMilitaryToMillionaire.com/investors where you can go and fill out information. And so if you wanted to look into some of these opportunities and be notified when some of these deals come across my desk and I'm pushing out opportunities, and you want to see those opportunities, go to FromMilitaryToMillionaire.com/investors, fill out that form. We'll jump on a call, make sure that we're a good fit for each other, and then you'll see those opportunities. Now, that doesn't mean you have to buy anything, but at least you see those opportunities. So a lot of investors have that stuff, and I meet people through networking and through content marketing that I find to invest in those deals. And that's the long and short of it. Now, there's 2 different kinds of syndications that are primarily used. There's different kinds of ways to do it, but there's a 506B, which allows accredited investors and up to 35 unaccredited but sophisticated investors, but you cannot advertise. So you have to have a previous relationship with the client or the investor. So that's why I say fill out the form and let's talk, because if you're not accredited and we're doing a 506B, or if you are accredited and we're doing a 506B, I cannot physically send you the opportunity to even look at unless we have a relationship, meaning we've talked on the phone, we've exchanged a lot of emails, we've met in person a few times, whatever that is, a substantial relationship that we can tell the SEC, like, yeah, I wasn't advertising. He and I or she and I had a relationship and I shot them the opportunity to look at. Now, the other is a 506C, which is accredited investors only, no sophisticated investors, but it allows for general solicitation or advertising to the public. So there's no public relationship or previous relationship required here. So the 506C means it's only accredited investors, but you can advertise. So if you see people advertising about their deals, then that's probably their 506c. And if you're not accredited, so bad, so sad. Like, sorry. If you don't know, the difference is accredited investor is $1 million net worth, not including your primary residence, or $200,000 in income, or $300,000 in income for a married couple jointly. And sophisticated investor is basically somebody who can be reasonably assumed can afford to take on that risk. Like, they understand what they're getting into. So that could be somebody who's just not an accredited investor but has a lot of rental properties, or maybe they're a commercial broker, or somehow, some way, they understand the risk they're getting into and they can show that. So they could be considered a sophisticated investor, and they could, potentially invest in a 506b as long as they have a relationship with that person. So it takes a lot of time and resources to put together a large syndication as a general partner. In fact, I have kind of realized over the last deal, I don't know if I ever want to be like the main guy on a capital fund or the general partnership. I prefer the visionary type thing, and there's so many moving parts and stress and timelines, and it's just, I kind of like the idea of being a general partner who helps with, investor relationships, maybe some due diligence and some basic stuff in the deal, but doesn't have to deal with all the the big checklist of things that have to be done. I like knowing what's going on. I don't know if I really like how intensive that is. I kind of like a single family home. It's like buy a house, base hit, buy another house, base hit. It's easy. Commercial real estate, there can be some great opportunities, but it is more complex. So if you don't want to deal with all that, maybe you become a partner on someone else's, as a GP, or you just invest passively. You get all the same benefits, but you're not on the general partnership. So some food for thought. It does not take resources to be a limited partner. It just takes the money, so you don't have to invest any time or whatever. And then if you are the general partner, it requires a large network. So you're going to have to get out there and network and do content marketing and stuff like that, because you're not going to be able to raise money for these big deals if you don't have a network in place. Because like I said, you have to have a previous relationship with people unless you're doing the advertising one, but then you have to advertise to accredited investors. You better have a track record because they're going to know what they're looking at. And so, a lot of people get started in real estate through friends and family when they get into the syndications and people they know in their sphere. So if you don't have that network built up, it's going to be really hard for you to get started. Now, real quickly, some of the risks associated with syndications are going to be outlined in the PPM, which is the private placement memorandum, or the offering, whatever, you know what I'm saying. Basically offering, like, it's going to be outlined in the investor package. But the nice thing with syndications is you can't lose any more money than you put in. So if you put $50,000 in, the worst thing that happens is you lose $50,000. Now, realistically, that's probably not ever going to happen because it's backed by a hard asset. So that hard asset will still have money. So unlike a stock that can drop from $50 to zero if the company goes bankrupt, if your property does really terrible, you can still sell it for physical value of the property, unless, there are ways, but your risk is limited to that $50,000. As a landlord owning a single family home, let's say you have $50,000 into a house and you get sued. Potentially, you could lose more than that $50,000 and the house, depending on the lawsuit. But in a syndication, if the property gets sued, as a limited investor, a limited partner, you put your $50,000 in, that's all you can lose. So now that's a little bit of limitation on the downside, but it's still not good, right? You don't want that to happen, but it's better than it could be. Now, look, I'm going to read this, but in 2009, at the bottom of the financial crisis, delinquency rates on single-family homes was 5% versus only 1% on multifamily apartments. So realistically, these are generally assumed to be more recession-resistant and hold up better just because people need a place to live, and apartments are generally fairly affordable. But again, a poorly operated property could result in you not getting the full return, not getting what you wanted out of the property, yada, yada, yada. Which is why I always say knowing who you are investing with is more important than what you are investing in. Now, don't get me wrong, the deal needs to be good, but if it's a good deal with a bad operator can still go bad. A bad deal with a good operator can still go good. I would rather invest in a mediocre deal with a great operator than invest in a great deal with a really bad operator, right? And so what I mean by that is someone who's experienced. Maybe they've seen a few properties through full market cycle, like the people I invest with, or they've been around for a while, or so like the team that I did this last syndication with, and we'll probably do more with, has $100 million in assets and over 1,600 units managed. They've seen some through full cycle. They've seen ups, they've seen downs. They've been here, they've been there. And so overall, they're pretty fairly weathered. They're conservative. They've been around. They know what they're doing. And that's big to me, right? If their investors have never lost money, all of those kinds of things, those kinds of track records. I'd like to see that the deals that go full cycle potentially earned more than what was projected. So if they said they were going to get a 15% return on investment, they got 17, great. That means they're under promising, over delivering, which is good. And so that's kind of the stuff that I'm looking for. A really good operator is very, very important. Now, look, if you don't meet accredited investor status and you don't, it's not a sophisticated, or you don't know people, right? Like, how do you get connected? So first off, if you're sophisticated, or you think you might be, or accredited, I would say like referrals. Like, ask people who you know that does syndications that they trust or whatever, or hell, ask me, I'll talk to you. But I am partnered on some, so I'll probably say you should jump on my investor list at that, from military2millionaire.com/investors. But there are other syndicators out there who are great, and there are some that are not. And I'll be more than happy to tell you the ones that I know are doing very well, and the ones that I know, maybe. Because unfortunately, if you were to post to my Facebook group, it would be like blood in the water for sharks. There are some really good syndicators who would comment, but there are also some syndicators who have like no track record at all that would be just circling and trying to get your money. And I don't think that's the way to do it. So don't ever invest with people you don't personally have a relationship with, or wasn't like personally recommended by someone you do have a relationship with. Like, make sure that they're good people that you're investing with. But if you're not accredited, you're not sophisticated, or you just don't want to do the apartment thing or the syndication thing, if you're a sophisticated investor, you can still invest in some of these deals as the 506B side, but you could also just get started in house hacking, right? Like I mentioned that real briefly here, but like my favorite investment strategy for a young service member or a young investor is house hacking. Whether that's you buy a single family house and rent bedrooms out, or you buy a duplex or a fourplex and you rent other units out, house hacking is great because it mitigates your cost of living, and it's just a great idea. You can do small, single family houses. You can do solo. You can do multifamily houses. You can do whatever. But you can also just do private money lending, right? So like if you really want to invest, but you're still kind of iffy on the syndication side, or you don't quite have like the 25 or 50,000 that a lot of syndications require, or you're not considered sophisticated, you can do private lending, meaning, well, I'm just going to use myself as an example. Let's say you gave me $20,000 and we bought a long-term rental together, and you paid the down payment, I got the debt, the deal, everything operating, and then in return, I give you 2/3 of the cash flow forever and 2/3 of the equity when we sell, or whatever. Or I give you a set 10% interest on that $20,000, so you earn $2,000 a year, and we hold it for 5 years, and then I refinance. It's like whatever that strategy is, there are ways to invest with people with cash or capital without having to be in the big deal, but syndications are fun, right? Limited partnerships are good. They're passive. If you're looking at that, I'd be more than happy to talk to you. We can jump on a call. I'll put a link down below to my Calendly link. We can schedule a call and talk through investments. It doesn't have to be syndication. It could be private lending. But if some of that stuff is interesting to you, let me know. I'd be happy to just throw you on my list so you can see opportunities that come your way. We don't have a deal at the time I'm recording this. There's no deal in the pipeline right now because we just closed a really big one and we're working on leveling that out. But there will be opportunities in the future. They're going to be awesome. So it never hurts, to get on a list and hear a little bit more about that stuff. So let me know. But I hope this just cleared up a little bit more about what a syndication is, how it works, how it's good for you. This is basic stuff. I'm not trying to go super in the weeds here. I'm just trying to make this somewhat understandable for you. So I hope you got something out of this. I'd love to hear any other questions. Comment down below. Smash that like button. Subscribe to the channel, or down there, wherever that thing is in the corner. There, right there. In that corner right there. Subscribe. Let me know what you thought in the comments. Other questions, other content ideas. I'd love to talk to it. Love you all. Have a great day.